Hello and welcome from Buenos Aires, Argentina, to this episode of Crossing Borders with Nathan Lustig, where Nate normally has conversations with entrepreneurs doing business across borders and the people who support them, with a focus on those that have some connection to Latin America. My name is Josefina Dominguezino, and I am an editor for LATAM List, a proud sponsor of the Crossing Borders podcast. Sign up for our weekly updates on latamlist.com to get a summary of the week's biggest headlines in Latin American tech news. Today's episode is the first of our Investor Remix series, where we go back to previous episodes to highlight the stories of some of the region's most successful investors. We hope you enjoy this episode featuring 6 investors giving advice to founders from Latin America. First up, we have Michael Sidgmore, partner at Broadhaven Ventures, who is passionate about economic development and financial inclusion.
Yeah, so it's a great question. I think there are 2 ways to answer this question. So one is like, what should a founder do? And 2, when they're pitching a VC, and 2 is how should a founder think about structuring their business? So pitching a VC, to be honest, I don't think they should do anything different from what any other founder would do, which is kind of show that they truly understand their market and their customer and understand what problem they're solving for their customer, and then have a passion for what they're doing and show like, this is why I'm building this business. I really care about it. I think one of the pitfalls you have of being in a market where there could be businesses that you copy from other regions is that people just think they can copy a business rather than actually be truly passionate about it. So I think, really having a true reason for why they want to do this. I'll use Nowports as an example. The founders, one of them comes from a 3rd-generation freight forwarding family, and the other founder went and worked for a freight forwarding company in Kansas City and had no connections to it, just cold emailed, cold called, ended up working there. And I think that to us showed true passion and understanding for the industry and a desire to change the industry. So I think when it comes to kind of, pitching VCs, it's do all the things that any other founder would do. To their credit, I think YC has done a very good job of training founders, and I think you've seen a lot of LATAM founders. There's an article in Contexto today, actually, the 53 companies that have come from Latin America that have been part of YC, and I think they've done a very good job of kind of helping founders get ready to pitch U.S. investors, because there are more U.S. investors thinking about coming down. So that's part 1. Part 2 is, how should a founder think about structuring their business? And I think this is where they can actually get into more trouble, and it's because the kind of venture ecosystem is a little bit less developed. You have a more immature angel ecosystem. So I think the landmines that founders can get kind of can fall privy to are really around like how they first fund their company. So you don't want an investor who controls too much of the business. You don't want an investor-led board early on in a company. And we've seen a number of companies, particularly in Mexico, where you have maybe an investor with good intentions, an angel investor, family office, et cetera, but they end up owning so much of a business early on, and they end up having an investor-led board where you have 2 investors to 1 founder on the board at seed stage. And that just looks very different from the US, and it makes it very hard for a US VC to fund a company like that. So I think being really careful about how you think about funding your business early on. I understand that the angel ecosystem is different than San Francisco, where friends are willing to fund friends and there's plenty of angels to go around. But as a founder, really think about how you want to fund your business from the very early stages, and then think about how you want to structure your business too, from a corporate structure perspective and entity structure. So as a US VC, we only invest in US or Cayman entities. We won't invest in a Mexican or Brazilian entity. And there are, very valid reasons for that. It's not that we don't want to. It's just that from a kind of liability perspective. Yeah, in Brazil, if you invest in a Brazilian entity, you can actually, every shareholder can be personally liable and personally sued. So you have to create some way to kind of have protections against that. So I think that's an important piece of it, that founders should, figure out how to get connected to the right law firms, and structure their company in the right way. That just makes it that much easier for a U.S. investor to end up investing in their business.
Next, we have Andrés Barreto from Firstock Capital, who strongly believes in Latin America's immensely talented pool of engineers and developers and encourages U.S. companies to look to the region the next time they're hiring.
Well, I usually try to break the traditional pitch meeting and I want to have a conversation. So I tell them, assume that I'm convinced that your market is the best market and your product is the best product. Otherwise, I wouldn't be meeting with you. So I've already vetted that before I'm taking the meeting. And so the conversation that I want to have is I want the entrepreneur to tell me what their main KPI is. And ideally, they would tell me, yes, my main KPI is bookings, my main KPI is weekly active users, or money lent, or whatever KPI is. And then we talk about what the rate of growth has been for that KPI and whether or not they know how to code, whether they live the problem, and how they met their team. Usually that can be a 30-minute conversation, and I'll tell them whether I invest or not that same day or in the call. But that's the ideal situation. But more often than not, we can't get past the first point of figuring out what that KPI is. And so a lot of entrepreneurs say, oh, yes, we've made $1 million in revenue. And so I have to explain to them and convince them that unless you're selling a device, there's probably a better KPI than revenue. It could be page views, it could be bookings, it could be rides, it could be nights, it could be something that shows the value that you're creating, and that's correlational to the valuation of your company, which is not revenue. And so once we land at that KPI, then it's another 20-minute conversation for me to get them to tell me what the rate of growth is. And I have to explain this is change over time. And they've usually never calculated it. They've never measured their KPI on a week-to-week basis or on a month-to-month basis. They've only been looking at absolute numbers. Like, oh, we have 1,000 downloads, or we made $100,000 in monthly run rate. But what I want to see is the rate of growth change over time. So then I have to help them, and this becomes a 40-minute call, figure out how many bookings they had the first week that they launched, then the second week, then the third week, then the fourth week. More often than not, I tell them just do the homework and then we'll do another call. So I think the biggest problem that I have when I have conversation with entrepreneurs is that they don't know what their KPI is, their key performance indicator, and they haven't measured what change over time has been. So they can tell me, yes, we're growing 30% month over month in bookings. They just don't know those numbers because they've never been asked those numbers, apparently. They only know that they have 10,000 downloads or they've made $500,000 in revenue.
So figuring out that number one KPI and then the rate of change should be something that all the entrepreneurs that are going to meet you should know before they get there.
For sure. I don't even look at the pitch deck. I don't look at the PowerPoint. I just want to talk about that and then learn more about the team. And that's it. And I'll make an investment decision within 30 minutes. Yeah. So as an entrepreneur, that advice is kind of what drives our investment thesis. So the first one is your co-founder should be somebody that will be good at whatever company you decide to build. So pick the co-founder before you pick the company. And that's just because I've lived through having a company that was an app store for software as a service, business apps, to doing an ad network with the same founder. Had I picked somebody because they're really good at software as a service, it would have made them useless in my ad network. So they have to be people that are at your level, that you admire, that you respect, that you trust, and that are charismatic. That's above or has more priority than being a great salesperson or a great engineer. And I expect that I can do the work they do and vice versa. Like, I'm not 100% sold on the idea that I have a technical founder, all they do is just code all day and they don't like talking to customers, or they're bad at talking to customers, or the business co-founder that can't put together a prototype together. I don't like so much the whole idea of complementary. Like, sure, you can be complementary, but building a company for 10 years requires more than just the selling or more than just the coding. So they should be pretty good at both. And that worked for me with my co-founders that were able to do both things, both the technical and the business side. Then second, and that's also because I did it the wrong way as well, solve problems. Like, the business opportunities are easier when it's a problem that you've lived yourself and you're the first customer, rather than seeing that there's a trend in Bitcoin or cryptocurrency and, I don't know, on-demand drone deliveries, and then trying to build a company around that. It's way better to solve a problem that you've lived or that you're currently living, because that's what's going to make you the trendsetter and you will be creating the new hot thing. And so that's my second advice. And then my third advice is to launch, and we talked about this, to launch your product where there's the largest number of customers that have the most money that will give it to you the fastest. And I also learned this from doing the TechCrunch of Latin America. I also tried at some point to do the user voice of Latin America. I'm sure I tried something else for Latin America. I forget. But, all of those just proved that it was just way harder to launch where there's less customers that have less money that will take longer to give it to you. So that's the advice I'd give to entrepreneurs, and that's why they are reflected in our investment theses.
Next is Amanda Jacobson, who went from the investor side of the table to working at a Mexican fintech startup called Oyster Financial as VP of Partnerships and Business Development.
I think for anything that you're doing, it's always really about listening and observing. The first 3 months, I didn't even know what our entrepreneurs did. And so it was really me taking the time to look through all the documents and research their websites. And when I didn't understand all of the technical things about regulations in healthcare in the US, going on YouTube and watching videos and reading books and trying to really fully immerse myself in just listening and asking questions. I think what's been really helpful for me is just owning how young I am and being very frank about the things I don't know. I've had amazing opportunities when I'm looking for mentors for our entrepreneurs to be in the office of the CFO of HSBC or speaking with the international directors of BlackRock or PayPal, and just being very frank and straightforward when I don't understand a concept or I don't understand how a startup's how someone is doing their credit risk scoring or how they are doing something innovative, being straightforward and asking them to explain it to me.
With over 15 years of experience in economic development, Joanna Posada founded Elevor Equity, an impact investment fund that focuses on fintech in Latin America and India.
At times, I think it's about what one goes through different, patience, understanding that investing is hard, that your companies will go through the ups and downs, that entrepreneurship is kind of a lonely journey, and we're entrepreneurs ourselves in a way, and one thing we've learned is that we need to be partners with the entrepreneurs that we partner in. So I think when I first started, it's really after over almost 15 years that you see that even at some point where companies were not doing well, we're having great exits from them at the moment. So it's all about working through the difficulties, finding aligned co-investors, finding aligned limited partners, and just finding the right entrepreneurs and investors to really go through that journey.
Next up, we have Mike Packer, partner at QED Investors, an investment fund which has participated in some of Latin America's top fintech deals.
But I think, trying to get in with a looser connection to, a partner versus a principal or an associate, I think can sometime kind of set things up the wrong way. And so I think the most important thing is kind of how you get in and how you get started and how you leverage things like warm introductions and that kind of stuff. And so I would encourage, entrepreneurs to do what they know how to do, which is be scrappy and find their way into firms where they think they might have a good fit or a good partnership potential with. Because at the end of the day, this is something where you're gonna find a partner who's gonna be with you. I mean, we think when we make investments, we're gonna be with you for 7 to 10 years, and you don't want to make that decision lightly. And so, even if a firm may look good on paper or you think it may fit before you've met them, it's much more important, in my opinion, to start making those relationships early so you can figure out who you want to work with as an entrepreneur. So, I think it's get in where you can in terms of a venture capital firm, and then work on building the relationships up. And most people who you're going to want to work with are going to be transparent about how things work and where things stand. And so seek those type of relationships no matter where they are within the firms. General advice here holds, right? So, what type of investments do you typically make? How do you interact with your portfolio companies over time? And what you're trying to figure out is how you fit into the way they think and the way that they make decisions, right? If you're seeking a $2 million from a fund that has a minimum, $5 million check, those are easy things, I think, to figure out. The more nuanced things, I think, depend on what you're looking for in a partner. So, and they hinge more on that second set of questions of how do you interact with companies, what types of companies have you invested in that have been successful, that have not, and I think those types of questions start to get to a little deeper on what is involved beyond kind of capital in this relationship. And I think at the end of the day, when you get to kind of really vetting VC, the references are going to be the most powerful, most telling. Whether it's a portfolio that they already have, if they're a very kind of tenured VC, or whether it's kind of professional or personal connections. I think that has been, from a lot of the situations I've viewed, that's been the way that I think a lot of the entrepreneur to entrepreneur conversations spark the most kind of insight on how funds and firms work. It's hard to run away from that kind of real data point.
Lastly, we have Wimar Bakasitik, venture partner at FG Labs, who focuses on building and investing in international marketplaces.
So my perspective in general with entrepreneurs is that if you're really building something that you like, you should just keep pushing and keep trying to make that happen. Obviously, the saying that building a small company is as hard as building a large company is absolutely true. And that's true when you think about, operations, building a product, building a brand, fundraising. Probably fundraising is even harder if you're not building a large enough business. So there's obviously a notion of, you should stop working on what you're building because it will never be big. You should start thinking about bigger ideas. And I would always push for that as long as what they're building is not something that they're really passionate about. Because at the end of the day, building any company is so hard and there's so many ups and downs on a daily basis that if you really like what you're building, at the end of the day, it really doesn't matter whether you're building, a $10 million business or a $100 million business. There are plenty of lifestyle businesses that are great businesses for the founders, and you might be able to just cash in a couple of million every single year, and that's absolutely fine, and that's more than plenty to have an amazing lifestyle in Latin America. So if that's the case, I wouldn't try to persuade people to stop building what they were doing as long as they really like it. I think if people are looking at building companies from a more opportunistic perspective, I would certainly advise them to think twice whether they want to do that or not, because building any company or building anything that has meaningful value will take 7 to 10 years. And if you're dedicating that big percentage of your life to doing that, you might as well do something that's either impactful or something that you like. Ultimately, the way I see this, I think it's kind of it's a threefold analysis, right? You should be doing something that, one, you really like, two, something that you're really good at building and have a competitive advantage, and then lastly, building something that people care about or something which is impactful. And I think if you find a business or a company or any type of project that has those three components, it's definitely worth pursuing the long term. Just going back to your question, one thing that I didn't answer is what are my thoughts about taking some money off the table? My recommendation for that would be you should definitely think about doing that regardless of whether you are in the US or in Latin America. One of the things that I've seen on both sides of the table as entrepreneurs and investor is that it's never too early to sell. Obviously, you don't want to be selling at very early stages. You don't want to be selling at a seed or Series A. If you've been working on a company for a few years, if it's a bootstrap company, or if you're at a point where you've raised money and you're a Series B company or Series C onwards, then it totally makes sense to think about just cashing out a little bit, de-risking your 5 to 10 year block and making sure that you were able to get some financial gain and then keep moving. I've been part of a few board and investor in a bunch of companies, and I've always been supportive of founders that have been working on a specific company for a few years, and it actually makes sense for them to take some cash out of the table. What I've also seen is founders trying to be too greedy with secondaries and not wanting to sell, and then things at the end of the day not working out and regretting that decision. I think an entrepreneur should always consider selling a small percentage of their stake. You shouldn't be selling, more than probably 15%, because if you sell more than that, you're just giving a negative signal to the entire company and the board and showing that you don't believe so strongly that the value of the company will continue to increase. But as long as it's a small percentage, that small percentage can actually represent a meaningful amount of an entrepreneur's net worth. And so it totally makes sense to consider that.
To close it off, Amanda gives advice to entrepreneurs on raising capital.
Understand just the self-awareness piece. We've also done some research with hundreds of entrepreneurs that are all early stage from across the world. And what we have found in our data with statistical significance at this point is that the entrepreneurs that have greatest self-awareness are those that do have most successful companies. In all metrics, from amount of funds that they've raised up to how the size of their team they've been able to build, their revenue metrics. And so I think it's really understanding what are your risks and what are your strengths. Do you have a strong team? And if not, being able to openly say, I know that I'm an app and this is what we want to be able to do. This is our vision. What we need with our next round of financing is to get a CTO so we could get to the next level. We self-recognize that we're not perfect, and this is where we need to improve. And I think with that self-awareness and really the open communication between entrepreneurs and investors, that is what's going to help them most be able to raise funding.
Thanks again for listening to this episode of Crossing Borders with our guests Michael Sidgmore, Andrés Barreto, Amanda Jacobson, Wimar Bakasitik, Mike Packer, and Joanna Posada. If you enjoyed this podcast, please share with a friend and give us a rating on iTunes or wherever you listen to podcasts. It's the best way to share what's going on in Latin America's ecosystem.